Welcome to the All Financial Hour podcast with Steve All.
I found a recent study that said that 1 in 5 over the age of 65 are actually still working. That's like 11 million Americans, Steve. A lot of folks out there. And most didn't return to the workforce because they wanted to, Steve. It's because they had to. But how are you helping folks avoid this?
I think the biggest thing for most people is most people don't know. They have that question, when can I retire? Will I run out of money? Those are the two greatest questions that almost everybody has, because everybody has a different opinion, a certain number before you can retire. I think the thing that you have to look at for that is get the analysis. We've had people that didn't think they could retire, and they come in and we run the numbers, but because of their pensions, their fixed incomes, they're set as far as income, but they didn't have as many assets. And then we got people with a whole lot of assets, but no fixed income and a very high expense. So it's always a picture, and it's looking at both of those. Because to me, I agree with Mel. The three most important things that you can have in retirement is income, income, and income. And we like to look at it if you don't have a pension. You could take some of those IRA or 401k assets that you have and build your own personally funded pension, where you're putting money into an account. We're going to pay you a lifetime income for you or your spouse. Yes, that is with an insurance company. The big thing is, if these people had fear of that, was if they prematurely pass, the insurance company gets to keep their money. That's not true. Most of these accounts, the money that's left over will go on to your heirs. Give us a call. Ask about that personally funded pension, just so you can figure out when can you retire and will you run out of money.
The stock market is betting that the Fed will cut interest rates by 50 basis points at its meeting later this month, and most investors are expecting 4 or more interest rate cuts this year alone. But analyst Mark Tepper, he tells Fox Business that this might not be the catalyst that Wall Street is looking for.
I don't think investors are really sure what they want at this point in time. They want rate cuts, but it's very rare that you get what's being priced in right now, 5.3 rate cuts by the end of January.
That's ridiculous.
Outside of a recession, right? So I think investors need to be careful what they wish for. If you go back through history, back to 1950, and you look at what happens to the stock market following the very first rate cut, on average, the stock market's down 23% in the 1 year after the first rate cut. So, again, be careful what you wish for.
All right, yeah, we've seen the market lose major ground before, only to make it up within, a week or so. So that jives with financial advisors who say, don't panic, stay the course, it'll come back, all that good stuff. But when is that not good advice, Steve?
Well, I look at it to the point where my crystal ball's broken. When people start trying to pick out what the market's going to do, 10% declines. Corrections are parts of markets. 20% declines. Bear markets are parts of markets. Those things are going to happen. To expect that that's never going to happen in the future is an unrealistic expectation. So what I like to look at is, are you prepared for no matter what the market does? Because as it says, compliance doesn't let us make a lot of guarantees, but I will guarantee you the market's going to do one of three things. It's going to go up, it's going to go down, or it's going to stay flat. Mm-hmm. And I think you have to have a plan that's built around all of those. And I believe that plan needs to fit your risk tolerance. Because when we start to look at things like now, I think having static management, where it basically is in the area buy, hold, readjust on an annual basis, because I think that's the part most people miss. We're going to reallocate the portfolio. That's static investment. And then we have tactical management. Tactical management says we are going to be willing to walk away from equities when we have market cycles that are really have a lot of headwinds. Well, folks, would you say we might have a few headwinds going on right now with the problems with Israel, Russia, interest rates? Mm-hmm. Not sure exactly how it's going to be affected by the Federal Reserve in a presidential election. So we've got a few headwinds that are going on out there right now. So our tactical models are not 100% invested right now. And I believe that's the part of leaving it to the money managers to say, when is the best time to move back in? Because I get a lot of people say, Steve, I'm sitting on cash right now. When do I go back in? I said, I don't have a crystal ball. But I said, let's come in and talk about our tactical models that aren't 100% invested right now. And when they believe that some of those headwinds have died down, they'll move back into the models. So we believe that is a very, very good way to go. And then you talk about protection. Most people say, Steve, I don't have to make a lot of money to stay retired. I just want to avoid the big losses. And that's where we look at it for ourselves. We're a full service firm, do assets under management, stocks, bonds, mutual funds, whatever you want to do that way. Mm-hmm. But I also do the fixed index annuities for protection of growth. Give me protection of the principal. I don't want it to go down. If the markets go down, the worst I can get is zero. Markets go up, I get to participate. So I think that is important. No income riders unless somebody needs income. I don't want any additional expenses. And then we also have custom notes. Custom notes are there for those people. How do you protect yourself if you don't use an annuity? Mm-hmm. I like the dual directional notes, and I like the principal protection notes. Bring in capital gains if I'm doing a non-qualified account versus ordinary income. I think those things are very, very, very important. So if you're looking at right now and you're concerned about what's going on with the market, the ups and the downs, ask for the risk-reward analysis, and we'll show you how you can protect yourself with or without using an annuity.
Steve, there's a new book called Social Security Horror Stories, and it talks about the common mistakes that people often make when they claim Social Security. One of them is being called the earnings test. So I want you to explain what this is, and is there a way to restore that money that is, taxed away?
Well, the idea around Social Security, it's old age survivors disability insurance. It was designed for people that, quote, lived too long. Now, when it first came out, life expectancy for a male was around 62, and you couldn't get it till you're 63. Now we have it availability at 62, and the average life expectancy is 85. It wasn't designed as a retirement plan. It was designed if you lived too long. So full retirement age, different for everybody depending on the year in which you were born. But full retirement age is when you get the full benefit that you would get from Social Security. If you go early at age 62, depending on the year you were born, you could take a 23 to a 30% decline in the monthly check that you get. The other caveat that they're talking about in this one is the annual earnings test. The annual earnings test basically says this year, if you make more than $22,320, for every $2 that you make above that, they will withhold $1 of your Social Security. And in this way, they say it's kind of taxed away. That is a statement. They will withhold the amount that you got overpaid, but you actually start getting it back when you hit full retirement age. So it's not like it's going away forever. It's just going away. Why? Because Social Security was designed for retirement. It wasn't designed to supplement your current income. So that is one of the things that we have to look at when we do a Social Security optimization. It's if you're single, it's a little bit easier. If you're married, could be a little bit more difficult. The rule of thumb that I use for a lot of married people, the lower earner of the two, turn on when available. When I say when available, it's usually around this annual earnings test. Doesn't do any good to turn it on if I'm going to give half of it back. Larger earner of the two, delay as long as possible. And the main reason why I believe that to be true is the amount that stays when one of the two pass away is the amount of the larger of the two. So that's where we want that to be the largest check possible. Most people don't realize with Social Security, every year you delay taking it, you get about an 8% increase in that monthly check. So between 62, if you wait till you're 70, about a 76% increase in the size of that check. Now, when people come in to do a Social Security analysis, I'm going to tell you right now, I can't do it in a vacuum. I have to be able to look at your other assets, run that full comprehensive plan. Why? It's hard for me to sit here and say, delay your Social Security from 62 to 70 if I don't have any idea how many assets you got. That's just a math formula. Those math formulas don't fit everybody. Maximum Social Security, both of y'all wait till you're 70 and turn it on and live forever. But that's not real life. That's not real life. So what we want to do is we want to run that full analysis so you can look at it and find out when is the best time to turn on Social Security. If people are close on that annual earnings test, I say turn on the Social Security. Why? I said they're going to give me the first $22,300. So if I make $1,000 more, I get to give $500 back. If I would give you $22,000 and you give me $500, how many times would you like to do that per year?
Right.
Over and over and over again. It's designed so if you're going to make $50,000, it doesn't make any sense in turning on your Social Security. So give us a call now. Ask for that Social Security analysis. Reminder, it can't be done in a vacuum.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.